Chapter 17, Auditors' Reports. Expressing an independent and expert opinion on the fairness of financial statements is the most frequently performed attestation service rendered by the public accounting profession. This opinion, which is expressed in the auditor's report, provides users of financial statements with an opinion on whether the statements are in conformity with the appropriate financial reporting framework, most frequently generally accepted accounting principles. The auditors cannot issue the standard report if there are conditions, although not departures from GAAP, about which the readers of the financial statement should be informed, such as lack of consistent application of GAAP, or there are material departures from GAAP in the client's financial statements, or the auditors are unable to obtain sufficient appropriate audit evidence, such as due to the client not retaining certain important records. Instead, they must alter their report to communicate such matters. Auditors most frequently report upon a complete set of financial statements, that is, the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flows and related notes. The purpose of the notes to financial statements is to properly disclose information required by generally accepted accounting principles that cannot be adequately conveyed on the face of the financial statements. Adequate disclosure in the notes to the financial statements is necessary for the auditors to issue an unmodified opinion on the financial statements. This slide shows the information that is contained in the standard audit opinion for public clients. The title of the report must include the words "Report of Independent Registered Public Accounting Firm." It must be addressed to the shareholders and the board of directors, or equivalent for companies not organized as corporations, although additional addresses may be added. The sections of the report include the opinion, basis for opinion, and critical audit matters, and these will be discussed in greater detail in the next slides. After the final paragraph, in addition to the CPA firm's signature, its city and state, and the audit report date, the report indicates when the firm began serving as its auditor. The first section of the report is the opinion. The first opinion paragraph will contain a description of the financial statements audited and a statement that the financial statements present fairly in all material respects the financial position, results of operations, and cash flows for the period in conformity with principles generally accepted in the United States of America. The second paragraph will state the opinion of the auditors for the company's internal controls over financial reporting and the framework used. When management has issued a report on internal control, but the auditors have only audited the financial statements, which generally occurs for companies with a market capitalization of less than $75 million, the second paragraph is deleted and additional wording is added to indicate that the auditors obtained an understanding of internal controls over financial reporting but are not expressing an opinion on internal controls. The second section is the basis for opinion and states that the financial statements are the responsibility of management and that the auditor's responsibility is to issue an opinion in accordance with the U.S. federal securities laws and the applicable rules and regulations of the SEC and the PCAOB. The second paragraph explains that only reasonable assurance is provided and states the audit procedures that were followed. It ends with a statement that the auditors believe that the audits provide a reasonable basis for the opinion. The third section, called Critical Audit Matters, is new and will become effective for years ending on or after June 30th, 2019 for large companies and December 15, 2020 for the remainder. It states that the auditors communicated to the Audit Committee certain matters listed below that relate to accounts or disclosures that are material to the financial statements and also involved especially challenging, subjective, or complex judgments. However, these critical matters do not alter the opinion of the auditors. The critical audit matters would then be listed. The information for each critical audit matter should include an identification of the matter, description of the principal considerations that led the auditor to determine that the matter is a critical audit matter, and how the critical audit matter was addressed in the audit. The standards require the auditors to include critical audit matters only for the current audit period, not all periods for which financial statements are presented, but the auditors may choose to communicate those of prior periods. This diagram presents a summary of the decision-making process for determining if an item is possibly a critical audit matter. Some factors that may indicate that an item should be included as a critical audit matter are assessment of the risk of material misstatement, including significant risk, degree of auditor judgment related to financial statement areas that involve significant judgment or estimation by management, nature and timing of significant unusual transactions and extent of audit effort and judgment related to them, nature and extent of audit effort required to address the matter, including the extent of specialized skills or knowledge needed, or the nature of needed consultation outside the engagement team, and the nature of audit evidence regarding the matter. The auditor's standard report for non-public clients has not been changed at this time, although there are plans to make changes similar to those that have been shown for the public company audit report. Independents should be included in the title, and the report should be addressed ordinarily to the company itself, shareholders, audit committee, and/or the board of directors. The report is signed with the name of the CPA firm unless the firm is a sole proprietor, and then it can be signed by the individual. It should be dated as of the date at which the auditors obtained sufficient appropriate audit evidence to support the audit opinion. The introductory paragraph of the auditor's report, as shown on this slide, identifies the financial statements that have been audited. The section titled Management's Responsibility for the Financial Statements states that management is responsible for the preparation and fair presentation of the financial statements in accordance with generally accepted accounting principles or another financial reporting framework such as cash basis if appropriate, and its responsibility for internal control. The auditor's responsibility section includes 3 paragraphs that first indicate that it is the auditor's responsibility to express an opinion on the financial statements based on an audit conducted in accordance with generally accepted auditing standards. Second, outline the nature of an audit. And third, conclude that the auditors believe that sufficient appropriate audit evidence has been obtained to provide a basis for the audit opinion. The opinion section presents the auditor's opinion on whether the financial statements are presented fairly in conformity with accounting principles generally accepted in the United States. United States was added because a number of nations have their own generally accepted principles, and those standards generally differ from one another. The 4 types of unmodified audit opinions include the standard report. This report may be issued only when the auditors have obtained sufficient appropriate audit evidence to conclude that the financial statements, taken as a whole, are not materially misstated, and there is no need to add an emphasis of matter paragraph, another matter paragraph, or to indicate a group audit situation. An emphasis of matter paragraph in an audit report follows the opinion paragraph and is included to refer to a matter that is appropriately presented or disclosed in the financial statements, but is being emphasized through the audit report. Another matter paragraph in an audit report follows the opinion paragraph and refers to a matter other than those presented or disclosed in the audited financial statements. The matter is, in the auditor's judgment, relevant to users' understanding of the audit, the auditor's responsibilities, or the auditor's report. An unmodified opinion on group financial statements involves a situation in which 2 or more CPA firms are involved in the audit of components of group financial statements, such as a subsidiary of a parent with 5 subsidiaries. When the audit firm that does the remainder of the audit does not wish to take responsibility for the work of the component auditors, the audit report is modified to divide responsibility between the CPA firms. There is no inclusion of an emphasis of matter or other matter paragraph in this situation. Modified opinions include a qualified opinion which states that the financial statements are presented fairly in conformity with generally accepted accounting principles, except for the effects of some matter. Qualified opinions are issued when the financial statements are materially misstated or when the auditors are unable to obtain sufficient appropriate evidence on which to base the opinion. The likely effects, while material, are not considered to be pervasive. An adverse opinion states that the financial statements are not presented fairly in conformity with generally accepted accounting principles. Auditors issue an adverse opinion when the deficiencies in the financial statements are both material and pervasive. A disclaimer of opinion most frequently is the result of a scope limitation that creates a situation in which the auditors are unable to obtain sufficient appropriate audit evidence on which to base the opinion. All significant reasons for the issuance of a qualified or adverse opinion or a disclaimer of opinion should be set forth in a basis for modification paragraph preceding the opinion paragraph. Primary circumstances that result in an audit report with an unmodified opinion but with additional financial statement related information include substantial doubt about the company's going concern status, generally accepted accounting principles not consistently applied, and other circumstances that the auditors believe should be emphasized, such as uncertainties, unusually important subsequent events, a major catastrophe, or a division of responsibility for the total audit. The professional standards require the auditors to evaluate whether there is a substantial doubt about the client's ability to continue as a going concern for a reasonable period of time, which is defined as not to exceed 1 year beyond the date of the financial statements being audited. Conditions that may cause the auditors to question the going concern assumption include negative cash flows from operations, defaults on loan agreements, adverse financial ratios, work stoppages, and legal proceedings. When such conditions exist, the auditors should gather additional information and consider whether management's plans for dealing with the conditions are likely to mitigate the problem. If, after evaluating management's plans, the auditors conclude that the substantial doubt is resolved, they may issue a standard report. If, on the other hand, substantial doubts still exist about the company's ability to continue as a going concern for a period of 1 year from the balance sheet date, the auditor will add a paragraph to their unmodified opinion or issue a disclaimer of opinion. Including an emphasis of matter paragraph with an unmodified opinion is the most frequent resolution. This slide illustrates an emphasis of matter paragraph relating to substantial doubt about a company's ability to continue as a going concern. United States auditing standards for both public and non-public companies require that the auditors evaluate the client's current period financial statements for consistency of application of accounting principles in relation to prior periods. The consistency is required for all periods reported on and the prior period thereto if presented. If only reporting on one period, then consistency with the prior period, whether presented or not. A lack of consistent application of accounting principles results in the emphasis of matter paragraph. Emphasis of matter paragraphs follow the opinion paragraph, which includes a statement that the audit opinion is not modified with respect to the matter. This slide illustrates an emphasis of matter paragraph for a lack of consistency in the application of accounting principles concerning the testing of goodwill for impairment. The auditor directs the reader's attention to the notes for additional information and also states that the opinion has not been modified in respect to this matter. While the professional standards require auditors to include an emphasis of matter paragraph in the circumstances presented previously, the auditor may elect to include an emphasis of matter paragraph in other circumstances. While all financial statements are affected to some extent by uncertainties, it is only to those whose outcome is unusually important that auditors consider adding an emphasis of matter paragraph. Other situations would include significant related party transactions described in a note to the financial statements. that the company is a component of a larger business enterprise or unusually important significant events, including a major catastrophe that has had or continues to have a significant effect on the organization. Also, if there are accounting matters affecting comparability, other than changes in accounting principles, of financial statements with those of the preceding year, the auditor may wish to add an emphasis of matter paragraph. This slide illustrates the relationship of a component and group auditors. Group financial statements are those of a company that is composed of more than one component or subsidiary. When one CPA firm audits the entire group, no particular audit reporting complications arise. It is when one or more components are audited by component auditors other than the group auditors that issues arise about the relative responsibilities of the various auditors. In this illustration, except for subsidiary C, the entire audit is performed by the group auditors. In this discussion, we assume that the audit report is required upon the overall consolidated parent company's financial statements. When component auditors are involved, the group auditors should determine whether sufficient appropriate audit evidence can reasonably be expected to be obtained regarding the overall group controls, the consolidation process, and the financial information of the components. In addition, the group engagement team should obtain an understanding of whether the component auditors are competent, operate in a regulatory environment with proper oversight, and will comply with all ethical requirements, and the extent to which the group engagement team will be involved with the component auditors and will be able to obtain necessary information on the consolidation process from the component auditors. As part of the process, the group auditors should communicate to the component auditors audit-related matters of which they should be aware. Some of the items include informing component auditors how their work will be used, ethical requirements, a list of related parties, and significant risk of misstatements. The group auditors have two basic reporting alternatives under both Generally Accepted Auditing Standards and PCAOB standards: to make no reference to the component auditors and as such assume responsibility for the entire audit, or to make reference to the component auditors and in essence divide responsibility for the engagement among the group and component auditors. This slide illustrates additional procedures that the group auditors would perform based on the nature of the component if the auditors make no reference to the component auditors. If the component is not significant to the group, then the group engagement team should perform analytical procedures at the group level and audit additional components if sufficient appropriate audit evidence has not been obtained. If the component is significant due to its individual significance to the group auditors or component auditors should perform an audit of the component. The group engagement team should be involved in the risk assessment and should discuss with component auditors or component management the business activities of significance to the group and susceptibility of the component to material misstatement. If the component is significant because it is likely to include significant risk of material misstatement to the group financial statements, then the group auditors or the component auditors should perform an audit of the components adapted as necessary to the needs of the group engagement team using materiality of the component, and should audit one or more component account balances, classes of transactions, or disclosures, and perform specified audit procedures relating to the likely significant risk of material misstatement of the group financial statements. This slide provides a summary of the effects of certain matters giving rise to emphasis of matter paragraphs and components of a group audit on the audit report when the matter is properly presented and when the matter is improperly presented in the financial statements. If going concern, consistency, and other discretionary matters are properly presented, then an unmodified opinion with an emphasis of matter paragraph is added after the opinion paragraph. If a group audit is handled either to refer to the component auditor or not, but is properly presented, then the report is unmodified, but the component auditors may be referred to if the group auditors do not take responsibility for the component auditor's work. If there is a departure from GAAP involved in the issues leading to emphasis of matter paragraphs causing the financial statements to be improperly presented, then either a qualified or adverse opinion is made and a basis for modification paragraph precedes the opinion paragraph. Both going concern and uncertainties can also lead to disclaimers of opinion. If there is an effect of a component auditor being involved in an improperly presented financial statement, then the effect is not applicable because it is an auditor reporting concern. This slide illustrates the auditor's judgment about the pervasiveness of the effects or possible effects on the financial statements of misstatements in determining the type of opinion that is issued. Misstated financial statements containing a departure from GAAP can result in an unmodified opinion only if the amount is not material, a qualified opinion if material but not pervasive, or an adverse opinion if material and pervasive. The inability to obtain sufficient appropriate audit evidence, which is a scope limitation, can result in an unmodified opinion if the amount is not material, qualified opinion if material and not pervasive, and a disclaimer of opinion if the matter is material and pervasive. In determining the proper opinion the auditor will issue when there is a departure from GAAP, the auditor will base the opinion on the materiality of the departure and whether it is pervasive. As stated in the previous slide, an immaterial amount can result in an unmodified opinion. A material amount that is not pervasive is in a qualified opinion, but a material and pervasive misstatement results in an adverse opinion. Effects of misstatements become pervasive when, in the auditor's judgment, they meet one or more of the following three criteria. They are not confined to specific elements, accounts, or items of the financial statements. If confined, they represent or could represent a substantial proportion of the financial statements, or in relation to disclosures, they are fundamental to users' understanding of the financial statements. This slide illustrates a qualified audit report. The introductory and scope paragraphs are standard. A basis for qualified opinion paragraph explaining the reason for the qualification precedes the opinion paragraph. The opinion paragraph includes the words "except for the effects of the matter or matters described in the basis for qualified opinion paragraph" to direct the reader to the qualification issues. The audit report for a public company that is qualified for a departure from GAAP includes an additional paragraph that follows the opinion paragraph in the opinion section and does not include a title before it. If a material misstatement is considered pervasive, an adverse opinion is appropriate. An adverse opinion is the opposite of an unmodified opinion. It states that the financial statements do not present fairly the financial position, results of operations, and cash flows. These opinions are issued when the auditors believe that the departure from GAAP are such that the financial statements taken as a whole are misleading. This is an example of the opinion paragraph when an adverse opinion is issued to a non-public company. When the auditors express an adverse opinion, they include a separate basis for modification paragraph, similar to that of a report with a qualified opinion, although the paragraph may be longer for a pervasive misstatement. This paragraph should precede the opinion paragraph shown above. The adverse opinion for a public company is similar, with changes similar to the one presented earlier for a qualified opinion. The PCAOB requirements to disclose critical audit matters do not apply when an adverse opinion is issued. Limitations on the scope of an audit may create a situation in which the auditors are unable to obtain sufficient appropriate audit evidence. Such limitations may occur due to circumstances that were beyond the control of the client, such as important accounting records being destroyed, or circumstances relating to the nature and timing of the auditor's work, such as the auditors were hired too late to observe the client's beginning inventory. The client can also impose scope limitations by not allowing the auditors to send confirmations to customers. Client-imposed limitations are very significant since they may have other implications for the audit, such as for the auditor's assessment of fraud risk and consideration of whether to continue the engagement or to withdraw. This slide shows an audit report that has been qualified due to a scope limitation. The first two paragraphs are the same as the standard audit report, but the auditors add a basis for qualified opinion paragraph to explain the nature of the scope limitation. The opinion paragraph includes the language except for the possible effects of the matters described in the basis for qualified opinion paragraph to direct the reader to the basis for qualified opinion paragraph. The public company audit report with a qualified opinion due to a scope limitation includes the following modifications to the standard unqualified report. The information in the non-public company basis for modification paragraph is added as a second untitled paragraph in the opinion section. The public company's second paragraph in the basis for opinion section begins with, "Except as discussed above, we concluded our audit in accordance with standards of the PCAOB." When the auditors conclude that the possible effects on the financial statements could be both material and pervasive, a disclaimer of opinion is appropriate. A disclaimer of opinion is no opinion. Auditors issue a disclaimer whenever they are unable to form an opinion or have not formed an opinion as to the fairness of presentation of the financial statements. Disclaimers cannot be issued when the auditors have formed an opinion on the financial statements. In particular, a disclaimer of opinion cannot be used as a way to avoid expressing an adverse opinion because auditors cannot ever avoid warning financial statement users about problems that the auditors know to exist in the financial statements. This slide illustrates the modifications to the audit report for a disclaimer of opinion. The scope paragraph is modified to state that the auditors were not able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Then a basis for disclaimer of opinion paragraph is included to explain the nature of the scope limitation. The opinion paragraph states that because of the inability to obtain sufficient appropriate audit evidence, no opinion is expressed on the financial statements. The disclaimer for a public company includes the following changes from the standard audit opinion. The title of the opinion section is changed to Disclaimer of Opinion. The opinion is disclaimed as shown in this example, except the paragraph describing the reason for the disclaimer follows the opinion paragraph without a title. The title of the Basis for Opinion section is changed to Basis for Disclaimer of Opinion, and the second sentence of the first paragraph on auditor's responsibility and the entire second paragraph are omitted, as well as the critical audit matters section. This slide illustrates the auditor's judgment about the pervasiveness of the effects or possible effects on the financial statements of misstatements in determining the type of opinion that is issued. Material misstated financial statements containing a departure from GAAP can result in an unmodified opinion only if the amount is not material, a qualified opinion if material but not pervasive, or an adverse opinion if material and pervasive. The inability to obtain sufficient appropriate audit evidence, which is a scope limitation, can result in an unmodified opinion if the amount is not material, qualified opinion if material and not pervasive, or a disclaimer of opinion if the matter is material and pervasive. An audit report may be qualified for two or more matters. For example, an audit report may include a modification for a scope limitation and for a departure from generally accepted accounting principles. The wording of the report should include appropriate qualifying language and explanatory paragraphs for both types of qualifications. When there are several matters requiring the qualification of an opinion, the auditor should consider the cumulative effects of those matters. If the effect involves material and pervasive known misstatements, an adverse opinion would be appropriate, not a qualified opinion. The auditors may express different opinions on the different financial statements in the audit. For example, if the auditors were retained after the client has taken its beginning inventory count and the auditors were unable to obtain sufficient appropriate audit evidence relating to that beginning inventory, the auditors may issue an unmodified opinion on the balance sheet and a disclaimer of opinion on the other financial statements affected by beginning inventory. The auditor's report should cover the current year's financial statements as well as those for the prior period that were audited by the firm. The auditors may express different opinions on the financial statements of different years. In addition, auditors should update their reports for all prior periods presented for comparative purposes. Updating the report means either re-expressing the opinion originally issued or, depending upon the circumstances, revising the opinion from that originally issued. In some situations, the current auditors have not audited the prior period financial statements because those financial statements are either unaudited or audited by predecessor auditors. If prior periods were unaudited, then the auditor should issue a disclaimer on those. If the prior financial statements were audited by a predecessor auditor, the report of the predecessor auditors may be reissued by them bearing the original date, or the current auditors may refer to the report of the predecessor auditors in another matter paragraph. The other matter paragraph should include that the prior period statements were audited by predecessor auditors, give the type of opinion expressed, and if the opinion was modified, the reasons therefor. The nature of any emphasis or other matter paragraph included in the predecessor auditor's report and the date of the predecessor auditor's report. Most publicly owned corporations are subject to the financial reporting requirements of the federal securities laws administered by the Securities and Exchange Commission. Many of the reports or forms filed with the SEC include audited financial statements for 1 or more years. Among the most important of these forms are the following. Forms S1 through S11 are the registration statements for companies planning to issue securities to the public. Forms SB1 and SB2 are the more simplified registration forms for small businesses. Form 8K is the current report filed for any time a significant event occurs for a company subject to the Securities Exchange Act of 1934. If the significant event is a business combination, then audited financial statements of the acquired company are often required. Form 8K is also used to report a change in auditors. Form 10Q is filed quarterly with the SEC by publicly owned companies and contains unaudited financial information, but the company's auditors perform reviews of this information. Form 10K is filed annually with the SEC and contains audited financial statements and other detailed financial information. And that is the conclusion for the demonstration for Chapter 17.